I think it's safe to say that we are officially in one of the weirdest housing markets ever, because anytime an expert comes out and they say that the housing market is booming, you have another expert come out and say that we are in a housing market bubble that's about to burst. That's why in this video, I want to give my thoughts about what's going on in the housing market. What's up everybody, I am Jaspreet Singh from theminoritymindset.com, where money minds rethink rich. Anytime you hear people talk about a housing market bubble or a potential housing market crash, it's kind of scary because we all remember what happened back in 2008. When the real estate market crashed, our entire financial system almost came down. Now, I'm not going to spend today's video talking about what factors could lead to a housing market crash because I already talked about that on YouTube. So if you want to watch that video, I will link it for you in the description below. Today, I really want to give my thoughts as to what's going on in the housing market, because we are really in one of the strangest housing markets of all time, because home prices keep booming faster than ever while millions of Americans are still unemployed and collecting unemployment checks, while interest rates keep going down and breaking new record lows. Here's the agenda for today. I kind of feel like I'm a teacher in class. This is fun. So today, we're gonna first talk about home prices. Once we get past home prices, I'm gonna get into mortgage rates and what's going on with that. Then I'm gonna get into jobs and the economy. Then I'm gonna talk about the X factor. This is really important to understand, especially when we're talking about what's coming. And then I'm gonna get into my thoughts, because you can't really understand what my thoughts are unless you understand these things. So let's get right into it. But before we do that, I need you to do me a quick favor and smash that thumbs up button below. Starting with home prices. Home prices are going up very quickly, which was kind of unexpected, because back in 2020, we obviously had the pandemic happen in March, and then our economy entered a recession, and then everything shut down, and all of a sudden, as things started to open back up, people started buying new homes. Now, some of this was obviously due to the fact that interest rates were slashed, but what happened was people started working from home, and then they realized that they didn't need to live and pay these high rents in major cities, so many people started moving to suburbs. And then when they started moving to suburbs, they were like, I want to have an office in my home. That way I have a place to work, because I don't have to go to the office anymore where I have to drive there. I could just work in my home office. So people started buying and developing these homes with an office inside. And so you suddenly saw this huge boom in people buying homes because people had this new work-life environment. Now, it's no surprise that home prices go up over time. Like back in 1970, if you wanted to buy a home, it would cost you something like $25,000. Now, if you want to buy a home, it's going to cost you way more than that. So we all know that home prices go up over time, and part of that is because of inflation. And so as your wages go up, you expect that home prices are going to go up too. But the interesting thing here is how fast home prices go up relative to wages, because in a healthy housing market, you want home prices to go up kind of at the same rate as wages, because if home prices go up too fast, then people won't be able to afford more homes. If that happens, where home prices go up way too fast, then what you're going to see happen is you're going to have all these people that want to buy a home but cannot because they can't afford to buy a home. And so if that happens, now you're going to have these sellers that cannot sell their home because nobody can afford to buy it. And so sellers will be forced to cut the prices on their homes, which would cause a housing market correction, not a crash, but a correction, that way people can actually afford to buy homes. And that's how you can create this market equilibrium. In 2020, not only did we see our entire economy shut down, and not only did we see millions of Americans lose their jobs, but we saw home prices go up by 12% in 2020. Now, for any of you that have been in the workforce for any period of time, chances are you know that your wages don't go up by 12% a year, even if you are in a good economy. Now, when you're in a bad economy, like we saw in 2020 when we were in a recession, wages go up even slower than that. So in 2020, we had wages that didn't really go anywhere. Actually, wages kind of went down because so many people lost their jobs, but home prices went up like this. You had all these people that wanted to buy a new home because people were moving out of big cities into suburbs, which created this new demand and new boom for home ownership. And at the same time, we also had such a small limited supply of homes available for sale because some people just didn't want to sell their home because of the whole pandemic going on. And at the same time, there was a material and construction shortage, which made it very hard and very slow for companies to be able to develop and build new homes. So you had a limited supply of homes, and all these people that wanted to buy homes. On top of that, you also had low interest rates, which made the demand to buy a home even higher. So you had a huge demand, limited supply, which pushed home prices naturally up. Now, I'm kind of a money nerd, in case you couldn't tell. And the thing that I think is most interesting about this is when people talk about rising home prices as either a good thing or a bad thing, because it's really not a good thing or a bad thing. It just depends on who you ask. Because if you ask a homeowner, hey, are rising home prices good or bad? It is great news, because if you're a homeowner, you bought your home for $300,000, and now your home is worth $500,000. So you just became wealthier because you built this newfound equity in your home by doing nothing except sleeping in your master bedroom. But if you ask a regular person who doesn't own a home, who wants to own a home, is this rising home prices a good thing or a bad thing? They'll tell you it's a bad thing because now everybody else who's a homeowner is getting wealthier while they're not getting any of the upside because they don't own a home. So rising home prices are good if you own a home, but it's not so good if you don't own a home. The second thing I want to talk about are interest rates, because low interest rates have been fueling this demand to buy a home. When people talk about being able to afford a home, there's two different things that you're looking at. You're looking at the price of the home and you're looking at what your mortgage rates or your interest rates are. So our interest rates are set by the Federal Reserve Bank, which is known as the central banking system of the United States. And typically the way it works is when we're in a slow economy or a recession, they will cut interest rates to make the economy grow even faster. The thing that's interesting about this is back in 2019, before we were in a recession, back when we were in one of the so-called best economies of all time, the Federal Reserve came out and they started cutting interest rates instead of raising them because they were kind of worried about future slowdowns in the economy. So in 2019, we already saw interest rates starting to come down, and then in 2020, the pandemic obviously hit, our economy shut down, and we entered one of the worst recessions since the Great Depression. Once that happened, the Federal Reserve Bank came out and they started slashing interest rates again, and then we saw mortgage rates go down to some of the lowest mortgage rates that we had ever seen in the history of time, and they continue to go down into 2021 because in 2021 we saw mortgage rates come down again to the lowest mortgage rates we had ever seen ever. Now again, if you already own a home, this is great news because now you might have gotten a mortgage at 4% or 5%, and now you can just refinance out of this mortgage into a new cheaper mortgage, and you can save tens of thousands, if not hundreds of thousands of dollars over the life of your mortgage by just refinancing to a cheaper loan. It's almost a no-brainer. If you do want to learn more about how to refinance the right way and how to save a bunch of money while refinancing, our team put together an article that explains exactly how to do it, and you can read the article on our website, theminoritymindset.com, and I'll also link it for you in the description below. But for those of you who want to buy a home, lower interest rates are kind of like a double-edged sword, because lower interest rates obviously make your monthly payments less, but when interest rates come down, what you see happen is you see this huge flood of people that all of a sudden want to go and buy a home because they want to take advantage of these lower interest rates. And so when everybody wants to buy a home, this pushes home prices up because now you have more demand to buy a home. And so now you're competing against 5 different people to buy that home, which means you guys are going to be bidding against each other to buy this home, which pushes home prices even higher. So yeah, you got a better mortgage rate and your interest rate is going to be less on the life of your mortgage, but chances are you're going to have to pay more money to buy the home now because there's so much more demand to buy a home because interest rates were cut. There's this thing in the real estate world called the 11% rule, which says that when interest rates are cut by 1%, home prices go up by 11% because this lower mortgage rate pushes more demand to buy homes, which causes home prices to go up by around 11%. The thing that I think is most interesting about this, because I'm a nerd, is the fact that the Federal Reserve has come out and they have already said that they plan to keep interest rates dirt cheap for years into the future. You know, it's impossible to predict what our economy is going to look like in 6 months or a year or 3 years, but the Federal Reserve Bank feels that our economy has been hurt so badly by this 2020 recession and pandemic that they have committed to keep interest rates at rock bottom for something like 5 years, which is absolutely insane. Now, there are rumors and speculation out there of people saying that the Federal Reserve Bank is not going to keep interest rates low for that long, but there's really no way to tell. There's no way to predict the future. But the idea that the Fed wants to keep interest rates at rock bottom for the next 5 years means that people will be able to buy homes with rock bottom interest rates for years. The reason the Fed is so scared to raise interest rates right now is because if they raise interest rates, the last thing they want is to see people stop buying homes and to see people stop spending money, because that could destroy the economy. And so they're trying to keep interest rates as low as humanly possible for as long as possible. That way they can stimulate the economy and get the economy moving like normal, whatever normal is now. So we have home prices that are booming, that keep growing faster than wages, and then we have interest rates that keep going down, which is fueling this housing price growth because now people want to take advantage of these low interest rates. And this brings me to number 3. Jobs and the economy. By now, we've all heard the numbers. 2020 was one of the worst economies since World War II. We saw tens of millions of Americans lose their jobs almost overnight, and our United States GDP fell by 3.5%, which is one of the biggest one-year drops that we've seen in the last century. The thing that's different about our economy now than before is, for one, many of the job losses were due to the pandemic and were temporary because we saw lots of temporary shutdowns in businesses. And secondly, the United States economy has created some backstops to protect it from just collapsing. The whole idea and hope here is as we kind of turn the corner in this pandemic, as vaccines roll out, as this pandemic goes away, as we get this herd immunity, people will be able to go back to work like normal. And so if people go back to work, which means people will start to go back to their offices, then people will start eating at restaurants for lunch. They'll start going to the local coffee shops. They'll start spending money again. They'll start driving their car. And as you start to see that happen, you will see more businesses start to grow again. This might be a little slow, but that's kind of the hope that people will start to live their lives normally, which will spur the economic growth again. The question that everybody's trying to guess, but nobody knows the answer to, is how long is it going to take and what's their economy really going to look like after this pandemic? Because most companies have kind of created this virtual first environment where, yeah, you can go back to the office, but you're not going to be required to go back to the office every single day. And so what is that going to do for the economy? I mean, are these local coffee shops and restaurants going to be able to thrive like they did before? I don't know, but that's where the government is also trying to come in, and they're trying to stimulate the economy with these multi-trillion-dollar stimulus packages, which are supposed to just inject money into the economy by giving money to people and businesses to kind of like quick start this economic growth. This is going to be a crucial factor when we talk about the long-term health of our housing market and the real estate market, because at the end of the day, jobs and the economy is what is going to support the real estate market and the housing market, because if people don't have jobs, they're not going to have an income stream. And if they don't have an income stream, they're not going to be able to go out and afford a home or be able to make their mortgage payments. And so it is so crucial that the economy starts to go back to normal and starts to function by itself without the support of the federal government, without the support of stimulus checks, because if it cannot do that, then people will not be able to have jobs to be able to support the housing market. Now look, I can guarantee that our economy is going to recover. I mean, the United States economy is the strongest economy in the world. The question is, how long is it going to take? And what does recovery really look like? Because chances are it's not going to be the same as pre-pandemic times, because things have changed. The work environment has changed. And so our economic environment has to change with it. If our economy is slow to adapt and we're slow to get away from this pandemic and we're slow to go back to normal, then we're going to see a very slow return of the job market, and that could really put a long-term damper or pain in the housing market. But if we can adapt quickly and we can get out of this pandemic quickly and we can kind of start to go back to normal, whatever normal is, quickly, then we can see the housing market continue to boom very fast, because now you're going to see millions of more people get jobs, which would push more people to want to buy a home. The thing you got to ask yourself here is who's buying homes right now? Because the people that are not buying homes are people that work in the restaurant sector or the retail sector or the travel sector, because these people are out of a job or not making any money because these industries have been absolutely demolished. And so you have a huge chunk of America that has not been able to take advantage of these low interest rates, that have not been able to take advantage of this housing market, while everybody else, maybe people who work in the tech industry, who work in finance, people who work in those kind of more office jobs that don't require your restaurant or retail or travel industries, these are the people that are buying homes. And so yeah, you have a chunk of America that's taking advantage of this housing market and this low interest rate market, but you still have a big chunk of America that isn't. And so if this side of the economy recovers, now you're going to have a whole bunch of people that will want to start buying homes again. You know, I think this is the hardest thing to predict, because it's so hard to imagine what our economy is going to look like in a year or 2 years or 5 years, because there's so much uncertainty. We don't know what's going to happen with this pandemic, and we don't know what's going to happen with our economy with all the money that we printed, and we don't know what's going to happen with businesses after all these businesses have been permanently shut down, and we don't know what our workforce or our office environment is going to look like once we're out of this pandemic for good. So the people that have been buying homes are not the people that lost their jobs to this pandemic. It's the people that were probably benefited by this pandemic or weren't affected by this pandemic, and they're taking advantage of the low interest rates, which is pushing home prices up, which brings me to number 4. Understanding the X factor. The X factor are things outside of the free housing market that can have a huge effect on the housing market. This would be things like the government. Our government doesn't know everything, and what the government does is, as we go through more economic crashes and more recessions, the government tries to create new backstops or regulations to protect us, or hopefully protect us, against future crashes. Sometimes what these regulations end up doing is they just create a bigger crash in the future, but let's just assume for the purposes of this video that the government can create regulations to help protect us against future crashes. But when the 2008 real estate crash happened, you had a whole chunk of America that lost their jobs, that were not able to pay their mortgages, and so you saw this huge wave of foreclosures hit the market, which caused real estate prices to crash because now all of a sudden you had this huge inventory of homes available for sale, but nobody wanted to buy a home, which pushed home prices down. The government did not want to see a repeat of 2008, and so what they did was they created this mortgage forbearance program where if you lost your job or if you faced a financial hardship, or even if you didn't face a financial hardship and you just wanted a break on your mortgage, you could apply for a forbearance on your mortgage, which means you could take a year off on paying your mortgage and not really face any penalties. And so you have millions of people that have a government mortgage, an FHA mortgage, a VA mortgage, or a USDA mortgage that are not paying their mortgages right now either because they're facing a financial hardship or because they just want to take a break on their mortgages. If this mortgage forbearance program didn't exist, then chances are we'd see millions of people get foreclosure notices and we see the supply of homes skyrocket, and chances are we'd have already seen home prices come down. The whole idea behind this is the government doesn't want to see home prices crash and they don't want to see a whole wave of foreclosures, and so they'll pay the price, they'll pay the cost to let people not pay their mortgages for as long as they need to until our economy can recover and until people can have an income again. That way they can start paying their mortgages like normal. Now, as a money nerd, let me tell you why this is so interesting. So if you go out and you get this FHA government mortgage, what happens is FHA gives you, I'm gonna make this you right here, draw you a nice mustache, you, draw you a nice turban too. You wanna get this mortgage, right? So you go to FHA, you get this money from FHA and you go and buy your home. FHA self-funds their loans, but the interesting thing about the FHA, the Federal Housing Administration, is they are insured by the Department of Housing and Urban Development. Now, if you are not paying your mortgage, there's a cost to that because the organization, the FHA or bank or wherever you're getting their money from, they have a cost to not getting their money back. And so the interesting thing here is when FHA is not making money, they have to absorb this cost. But who is actually paying for that cost? Well, FHA is insured by HUD. And who is HUD insured by? Well, none other than the US government. So when the FHA loses money, they just go to HUD. And when HUD loses money, they just go to the United States government. Lucky for us, the United States government has a whole bunch of extra cash laying around, right? Wrong. The United States makes money through you, taxpayers, through tax dollars. And the United States doesn't have enough money to pay the regular bills. That's why you keep hearing about the national debt skyrocketing. And so the person who ends up paying the price of you not paying your mortgage is none other than you. Because you're the one that's paying the tax dollars to the government. And so when you're not paying your interest on your mortgage, there's a cost that is eaten up here. And the person who's paying for that cost is you. The second thing I want you to pay attention to when it comes to this X factor is Joe Biden's plan to kind of help stimulate and boost the housing market, because he has a plan where he wants to give first-time home buyers a $15,000 credit for free. That way when you go to buy a home, you get this free $15,000 credit to help you with your down payment. The whole idea behind this is home prices have gone up so much that it has become harder for a first-time home buyer, a millennial, a young person to be able to buy a home, because lots of these young people do not have money put aside to actually go out and buy a home. And so to help these people, the federal government and Joe Biden have said that they want to create this plan where they give you $15,000 for free to help you buy a home. Now, is this plan going to get passed or not? That I don't know. But if this plan gets passed, you got to imagine that it's going to bring a whole new wave of buyers into the market, because everyone's going to want to take advantage of this free $15,000. So what's going to happen? You have a whole new wave of buyers entering the market if this happens, which would push home prices up even more, because now people want to take advantage of these low interest rates, they want to buy homes, and hopefully the job market starts to recover, which would push more buyers into the market as well, which would push home prices up even more. And this finally brings me to number 5, understanding my thoughts on the housing market and what is going on and what's going to happen this year. Home prices and real estate prices, like every other asset in the world, are cyclical. There's times where home prices are going to go up, and then there's times where home prices are going to go down. The things that cause home prices to go up is when you have more demand to buy a home than supply, because when you have more demand than supply, this pushes home prices up because now buyers are bidding against each other. But if home prices go up too much and now people can't afford to own a home, or people don't want to own a home, now you're going to see a shift where there's more supply than demand, and this kind of causes the real estate market to correct and real estate prices come down. This doesn't mean it has to be like 2008 where you see an all-out real estate collapse, but you can see real estate prices correct, and then when real estate prices correct, that's when people say, ooh, home prices are cheap, let me go out and buy a home. And then you start to see the cycle happen all over again, because now people want to take advantage of these low home prices. Here's the thing, it's nearly impossible to exactly predict when a cycle is going to start and when a cycle is going to end. But the things that we can pay attention to are the four things that I just talked about. You can look at home prices and interest rates and the job market and the economy, and then you can look at the X factor. And if you kind of add up all these things together, then you can kind of get an idea of what you think is going to happen in the housing market. Starting here, home prices have been booming. But the concern here is how sustainable is this housing price boom, because we've been seeing home prices grow way faster than wages. And so if home prices continue to grow at this pace, eventually home prices are going to outprice buyers, and buyers are just not going to be able to afford homes. So this right here is a little bit of a concern, because how long can you really see home prices go up at 12% a year while wages are only going up by 2 to 3% a year, if that, because we're still in a recession? But then if we come and look at interest rates are dirt cheap, and this is fueling more and more people to go out and buy a home because people want to take advantage of these low interest rates. I mean, that's just the reality of life. When interest rates come down, people go out and they borrow more money and they buy a new home or they buy a bigger home. And so this is pushing more and more people to go out and buy a home because people want to take advantage of these dirt cheap interest rates. Then if we look at jobs, this is a big question mark, because it's impossible to understand where our economy is going to be in 6 months or a year or 2 years. But the hope is that we're turning the corner on this pandemic, so more people are going to be able to go back to work, so more people are going to be able to have an income, so more people are going to be able to go and buy a home because now they have an income, so they can get qualified for a mortgage to buy a home. So as our economy starts to recover, chances are you're going to see more people want to go out and take advantage of low interest rates and buy a home. And as our economy starts to recover, more people will make more money, which will make them want to go out and buy an even bigger home. So if our economy continues to recover, this is going to push more people to want to go out and buy a home, which would push home prices up even more. And this brings me to the X factor. We have already seen that the government is going to do whatever they can to kind of prevent these foreclosures or prevent a housing market crash. Now, will it work? Well, it looks like they're going to do whatever it takes. They're going to let people forbear their mortgages, and they're banning banks from actually foreclosing. So the government is doing whatever they can to protect homeowners, to protect people from going into foreclosure. And at the same time, they want to incentivize people to go out and buy a home by creating things like this $15,000 credit that where people can have free money to help them with their down payment. So it looks like the government is doing whatever they can to help home prices go up, to help the housing market, and to make it easier for you to go out and buy a home. Now, what does that mean over the long term? Well, if more people have free money to go out and buy a home, then long term, that probably means the home prices are going to go up even more, because if people are getting $15,000 for free to buy a home, then you might see home prices go up by another $15,000, because people will know that you're getting an extra $15,000 to buy your home. And so as you see this flood of people start to buy homes, that could naturally push home prices up even more. So when we're talking about the short term, especially over the next year, again, I could be completely wrong. Remember, I'm just a random guy on YouTube, but it looks like home prices are going to continue to boom because we have so many factors that are pushing this housing market up. I mean, we have interest rates in the Federal Reserve Bank that are trying to cut interest rates for as long as possible. That way you can go out and buy a home for a dirt cheap mortgage rate. We have the economy starting to recover, and we have the government doing whatever they can to incentivize you to buy a home to support this housing market. So it looks like home prices are going to continue to go up, especially over the short term. But the concern here is what's going to happen over the long term, over the next decade. My concern is not in the short term when it comes to the housing market. I think we're going to continue to see a boom in housing market in the short term. My concern is what's going to happen over the long term, because we have home prices that are growing very quickly while wages are not keeping up with that. And we are incentivizing people to go out and buy a home even if they might not be able to afford it. And so if we have a ton of people buying homes who maybe cannot afford it, what's going to happen when the economy starts to slow down then? Because if we have a whole bunch of people that cannot afford the home they're living in while the economy is slowing down, that's a recipe for a disaster. So my concern is not in the short term. My concern in the housing market is what's going to happen in the long term if you have a ton of people owning a home, they can't afford the home that they're living in. Thank you for watching. If you enjoyed this video, here's a video about how to buy a home that I think you'll love. And while you're at it, subscribe to our YouTube channel and join our free finance and business newsletter. And as always, keep hustling. So your real estate agent is in the business of trying to get you a home. Your banker's job is trying to get you finance for the home. So your banker, also like your real estate agent, does not get paid unless you actually buy the home. So your banker's going to try to do everything they can to get you a mortgage